Most beginner traders do not lose because the market is impossible. They lose because they trade without a plan. In the next 12 minutes, I'm going to show you exactly why 90% of new traders fail in their first year, and more importantly, how you can avoid becoming part of that statistic. This video is for educational purposes only and is not financial advice. Trading involves risk, and you should never trade with money you cannot afford to lose. Let me start with something most trading educators won't tell you. The market doesn't care about your hopes, your dreams, or how badly you need to make money. It operates on supply and demand, driven by millions of participants making decisions based on their own analysis and emotions. When you enter a trade without understanding this fundamental reality, you're not investing, you're gambling. Now let's break down the 6 main reasons beginners lose money. First, trading without a plan. Imagine trying to build a house without blueprints. You might get lucky and put up a few walls, but eventually the structure will collapse. Trading is no different. A trading plan defines your entry criteria, exit criteria, position sizing, and risk management rules. Without it, every decision becomes emotional and reactive. Look at this chart. These red marks show entries and exits made without a plan. No consistent strategy, no clear rules, just random decisions based on emotion and impulse. The result? An equity curve that looks like a roller coaster heading downward. Every successful trader you've ever heard of follows a written plan, every single time. Second, poor risk management. This is the #1 account killer. I've seen traders risk 50% of their account on a single trade because they were sure it would work. Even professional traders with decades of experience lose on individual trades. The difference is, they never risk more than 1 to 2% of their capital on any single position. This means they can be wrong 40, 50, even 60 times in a row and still have capital to trade with. Look at the difference. Same losing trades, but the trader risking 2% can survive and learn. The trader risking 50% is out of the game after 2 losses. Risk management isn't about making money. It's about staying in the game long enough to learn how to make money. Third, emotional decisions. Fear and greed are the 2 emotions that destroy more trading accounts than any market crash ever could. When you're winning, greed makes you hold positions too long, turning profits into losses. When you're losing, fear makes you exit good trades too early, or worse, hold losing trades hoping they'll come back. The market rewards discipline and punishes emotion every single time. Here's a perfect example. This trade hit its profit target, but greed kept the trader in the position hoping for more. Price reversed, and what should have been a winning trade became a loss. Discipline means following your plan even when emotions scream at you to do something different. Fourth, overtrading. New traders often think more trades equal more profit. This is completely backwards. Every trade has a cost, not just in commissions and spreads, but in mental energy and risk exposure. Professional traders might only take 5 to 10 high-quality setups per week. Beginners often take 5 to 10 trades per day, most of them mediocre at best. Look at this chart. The yellow marks show all the mediocre trades a beginner might take, chasing every small move. The green marks show the only 2 high-quality setups that actually appeared. The beginner takes 15 trades, loses money on commissions and bad entries, and ends the day frustrated. The professional takes 2 trades and ends the day profitable. Quality over quantity, always. Fifth, following random signals. Social media is full of people posting trade ideas with no context, no risk management, and no accountability. When you blindly follow someone else's signal, you don't know their entry price, their stop loss, their position size, or their exit strategy. You're essentially flying blind, hoping someone else knows where they're going. Here's what happens when you follow a signal without context. You enter the trade, but you don't know where to exit if it goes wrong, or where to take profit if it goes right. Compare this to a proper setup with clear support, confirmation, stop loss, and target. One is gambling, the other is trading. Learn to analyze your own setups instead of depending on others. Sixth, trying to recover losses quickly. This is called revenge trading, and it's a death spiral. You lose money on a trade, feel frustrated, and immediately jump into another trade with a larger position size to make it back. This almost always leads to even bigger losses, which triggers more revenge trading until your account is gone. Look at this sequence. First loss, manageable. Second loss, painful. Third loss, account destroyed. Each loss was bigger because the trader increased position size trying to recover. This is how accounts get blown up in a single day. The solution? Accept losses as part of trading. Stick to your risk management rules and never, ever increase position size after a loss. Now that you understand what not to do, let's talk about the solution. The path to consistent trading starts with education, not execution. Before you risk a single dollar of real money, you need to understand market structure, price action, support and resistance, and basic technical analysis. This isn't optional. You wouldn't perform surgery after watching a few YouTube videos. Trading is a skill that requires study and practice. Next, use demo trading extensively. A demo account lets you practice with fake money in real market conditions. This is where you test your strategy, refine your entry and exit rules, and learn to manage your emotions without financial consequences. Spend at least 3 to 6 months in demo, and don't move to real money until you can show consistent profitability over at least 100 trades. When you do start trading real money, risk small. Start with the minimum position size your broker allows. Your goal in the first year isn't to make money, it's to not lose money while you learn. Think of your first year's trading costs as tuition for the most valuable education you'll ever receive. If you can break even or lose less than 10% in your first year, you're ahead of 90% of traders. Follow a written trading plan, always. Write down your strategy, your rules, and your risk parameters. Before every trade, check your plan. After every trade, journal what happened and whether you followed your rules. This creates accountability and helps you identify patterns in your behavior. Most traders fail not because their strategy is bad, but because they don't follow it consistently. Finally, focus on discipline, not quick money. The traders who succeed long-term are the ones who treat trading like a business, not a lottery ticket. They have realistic expectations, they manage risk religiously, and they understand that consistency over months and years matters more than any single trade or even any single week. Let me show you some specific examples of common mistakes using actual chart scenarios. First, entering a trade without confirmation. Look at this chart. Price is moving up, and a beginner sees this momentum and jumps in, hoping to catch the move. But there's no clear support level, no consolidation, no confirmation that the move will continue. Price immediately reverses, and the trader is stopped out for a loss. The professional waits for price to pull back to support, consolidate, and show signs of continuation before entering. Second, entering near resistance. This is a classic mistake. A trader sees price breaking out and enters right as it hits a major resistance level. What happens? Price rejects the resistance and falls, triggering the stop loss. The smart approach is to wait for price to break through resistance, retest it as new support, and then enter on the continuation. Third, trading without a stop loss. Some beginners think they can manage the trade and exit manually if it goes against them. This is how small losses become account-destroying disasters. Look at this example. Price moves against the position, and instead of taking the small loss, the trader holds, hoping for a reversal. Price continues falling, and what should have been a 2% loss becomes a 20% loss or worse. Fourth, risking too much on one trade. Here's a scenario where a trader risks 10% of their account on a single trade. The trade goes against them, and they lose 10%. Now they need an 11% gain just to break even. After 3 losing trades at 10% each, they're down 30% and need a 43% gain to recover. Compare this to risking 1% per trade. After 3 losses, they're only down 3% and need just a 3% gain to recover. Trading is not about predicting every move. It is about managing risk, controlling emotions, and staying consistent. The market will always be here. There will always be another trade, another opportunity. But if you blow up your account chasing quick profits or revenge trading after losses, you're done. Protect your capital first. Learn the skills second, and profits will follow as a natural result of doing everything else correctly. Remember, this video is for educational purposes only and is not financial advice. Trading involves significant risk, and most traders lose money. Never trade with money you cannot afford to lose, and always do your own research before making any trading decisions. If you found this valuable, consider subscribing for more honest, no-nonsense trading education. Thank you for watching.